Everyone, and welcome to this webinar video on what to do when markets are scary and you are in the process of divorce. I am Jacki Roessler of Roessler Divorce Consulting, and I am co-presenting this today with Lauren Adams, who is a certified financial planner and the co-managing partner at the Center for Financial Planning in Southfield, Michigan. And we're both based in Michigan, but a lot of these concepts are going to apply no matter where you're living in terms of what we're going to be presenting. And this comes up again and again. So we are really excited to be able to have the opportunity to record this. And hopefully, if you're watching this, I'm assuming it's because we are going through rocky markets. And that's why we sent this out to you. So hopefully this will answer a lot of questions and calm a lot of your fears. So Lauren, why don't we dive into it?
All right. Well, Jacki, thank you for having me. It is an honor to be one of the people you call when you need a voice of reassurance for your clients. So thanks for having me, and we hope to give that voice of reassurance today, and also some practical tips that people can do really immediately to feel like they have a control during a time that otherwise feels scary. So, um, as you said, there's been a lot in the news. Tariffs, Fed confrontations, cabinet shakeups, government shutdowns, and I'm sure there's probably been a dozen other things since when we recorded this video and when it
Right.
airs. There is no shortage of things to worry about. And if you're in the midst of a divorce, or maybe just emerging from one, these headlines are probably the last thing that you need to add to your mental load. So, our firm, the Center for Financial Planning, has been doing this work for 40 years. And again, we are honored to speak with your clients, Jacki, during this volatile time. And really, my goal is to help your clients maintain perspective, avoid emotional decisions, and stay committed to their financial plans.
Sounds good to me.
So let's talk about these headlines a little bit. A new regime in Washington this year has heralded many new things, just a few of which are shown on this slide. And it all comes wrapped in a sensationalist media approach. So if you are feeling whipsawed, you are certainly not alone. For many, this type of uncertainty can trigger a fight or flight response, which is a physiological reaction that can take over our rational thinking, and it's based on millennia of our brain's evolutionary development. So when we feel threatened, like when scary things happen on the news or our accounts go down significantly from what we've seen, our brain diverts resources from logical reasoning to instinctive action. So, in other words, it is harder to think clearly when fear takes over. And first, I want listeners to know that it's okay to feel this way. It's actually even normal. Especially for this group, Jacki, your clients, where I'm imagining that your emotional tank is probably already depleted and maybe tolerance for additional stress is less than before you entered a divorce chapter. So I feel like our listeners maybe are especially vulnerable for feelings of panic, feelings of being scared. Um, so I understand and we see you is, I guess, the first message here. So, most recently, tariffs have been the major source of volatility as of late. And, there certainly is a lot to think about when it comes to tariffs, from, the impact on the earnings of the stocks you might own in your financial accounts, to if your company or maybe your loved one's company might be doing layoffs, and then all the way down to how grocery prices might be affected. And, the saying is history may not repeat, but it certainly rhymes. And we do have the
Yeah.
first Trump administration's track record to go back to as a guide. I'm hesitant to get into the weeds on what's happening with tariffs at this moment in time because, as we've seen, this can turn on a dime. But what I want to reiterate is, yes, even a minimum level of tariffs can affect a wide range of goods and services because we do have an interconnected global supply chain. But in recent years, we've seen that trade deals soften the impact of those initial early sensational tariff announcements, which later we look back on and wonder if they were negotiation tactics. And we're already seeing that trend play out this year. So just what you might hear on the headline might not be what ends up happening. So that's something to think about. And while we wait for this deal, or again, maybe when our viewers are seeing this, maybe it's a Fed shakeup or a cabinet announcement or a government shutdown. So while we wait for that to pass, we want, or brace for the next market worry, which we know comes because they come over time. I think this chart is helpful for our listeners. So what this shows is the S&P 500 index, which is a big stock market index made up of the largest US companies. And you can see that it's that blue line that kind of goes up over time. So this is showing what happens to investing a certain dollar amount in just US stocks over time. Is that over the long term, it's a pretty great opportunity that the stock market offers some pretty incredible rewards. But if you look at the red line, what that is that's the drawdown of an account value at that given time. So those amazing returns do not come for free. And in this instance, one of the steepest costs investors have to pay in exchange for those great long-term returns is living through scary times. So they might have seen, like in the time of 2009, their retirement savings get cut in half.
Wow.
51%, from the top to the bottom for the US stock market. But when you zoom out and you look at this chart, I mean, it is a kind of a small blip, even though it certainly didn't feel like it when you're in it. So for those that didn't panic and stuck to the plan, they were able to ride it out and benefit from a recovery. Because downturns are normal. You look at this chart, which is one of my favorites from JP Morgan. The gray bar shows the return of that same S&P 500 index for a calendar year. But the red dot shows the steepest intra-year decline. So for instance, in 2020, at one point, stocks were down 34%, but then reversed course and ended up 16% for the full year. And as you can see, there's a red dot in almost every year, and they average 14%. So again, downturns are normal, but the good news is that upturns follow downturns, and they typically last much longer. So as we brace for an onslaught of headlines and more market volatility, know that some of the sharpest stock market increases often follow the largest pullbacks. And that is why it is important to remain invested. So studies have shown that if you panic and sell during scary times and miss just the 5 best days, which by the way, usually follow those worst days, you can cut your return by 35% from those 5 days alone. So that's why it is far better to remain invested. And this chart shows, during recessions, those drawdowns that we saw, another version of some of the charts I've already shown. But look at those 1, 3, and 5-year returns after those recessions. They're very significantly positive after we go through these periods. So hopefully by now, our listeners haven't gathered that they don't believe that our firm believes in market timing. I hope I've shared that, or abandoning evidence-based investment strategy. And we feel like market volatility comes with the territory of being a long-term investor. So that said, though, we certainly just don't sit around and do nothing when markets get rocky. So there are things that we can do. We can do going in, we can do we're in the middle of it, and then we can do just long-term as best practices. So the first and most important decision that we make is talk to clients about what their long-term strategic asset allocation should be. And this chart shows one of the most fundamental concepts of wealth management, and it's the trade-off investors make when picking an asset allocation. So if you look all the way to the right, a portfolio of 100% stocks, you'll see the average return going back to the 1950s was almost 13%. However, your range of returns went all the way down from -38 to +60, which is quite the spread. So that is too risky for most investors' tastes, especially for those that are approaching retirement and living off their portfolio. So we work with clients to determine the right mix for them. And diversification of not only stocks to bonds, but what types of stocks and what types of bonds is important. And it can help protect portfolios from some of the worst market declines while also allowing to participate in market gains. It's finding that right mix.
So Lauren, can
So,
I ask you a question? Just looking at this slide, so I'm trying to look at it with the view of someone who's not familiar with these differences. So what you're saying here is that like if somebody had a 100% bond portfolio, they
yep,
could anticipate getting 5.8% as a rate of return, an annual rate of return. Whereas if they were 100% in the stock market, they would be looking more at 12 or 13%. Is that right?
that's what this chart's showing. But, I will have to say this is going back to 1950. So this is showing what you would have gotten, maybe not necessarily. That's a
Okay.
whole other conversation, what to
Sure,
expect for
yes.
the
So this
future.
is historically. Um,
Historically, about 75 years, this is what investors of these portfolios would have seen. And again, you got it right. 100% bonds saw going back to 1950, 5.8, and on the flip side, 12.8 in all stocks. Yeah,
Got it. So incrementally, you could expect more return when there's more risk in your portfolio.
right. But a lot more ups and downs. So you can see that spread of returns gets a lot bigger.
That is a crazy spread up there on the far right.
Yeah, 100%, plus and minus. So
Wow.
and it's good to know that even if you were, Jacki, as you mentioned, that 100% bond portfolio, or somewhere in between, is that diversification is really great. And it's kind of the core of what any financial advisor works with for clients, but it doesn't eliminate all risk. There's
Hmm.
still variability on all of these charts. Um, and it is just that price of remaining invested that we already talked about. And times like this, scary times, are a really good time to check in and say, did I pick the right one? How do I feel about how much my accounts are fluctuating? It's one thing to talk about it with an advisor, when things are great. It's
Hmm.
another thing to see how you feel when you're in the thick of it.
Right. Well, that's why I
So
appreciate the work that you guys do with clients because I think that you prepare them for,
yeah,
how do you feel? How are you going to feel if the market is way up and you're invested in a balanced portfolio versus how are you going to feel if you're on that downside of that?
yeah,
And a lot of people can't sit through that.
yeah, right. You have to, sometimes you can even, we think about, if we're in the thick of it, let's write a note to ourselves and remember how we feel so that when markets turn around and we feel like we want to be getting that very aggressive return, we remember what it felt like.
It's
It
a
can
great
cut both
idea.
ways. It can
Right.
cut both ways. And this chart, Jacki, this is really a very high level approach to financial planning. It assumes long-term goals, but I think we're going to get into later that you may need different asset allocations depending on what types of goals we're talking about. So like we'll just kind of allude to that now, but we'll get into it a little bit later, which I think is especially important working with clients going through a divorce, emerging from a divorce. They might have retirement, but then they also might need to figure out how they're going to buy a house. And those timelines and those asset allocations might differ, but depending on the timeline.
Right.
So asset allocation and then making strategic adjustments within client portfolios that align with the current view and outlook for the various fixed income and equity markets. It's a core part of what we do as advisors. But there are also other financial planning strategies that we review and potentially deploy during scary times that can also add value to financial plans. Sometimes I call it, making lemonade out of lemons, tax lemonade out of when the market gives you lemons, for example. What can we do and what can we control? So the first is um, positioning ourselves as, again, I'm going to keep saying this because I really feel like people need to hear it during these times. Bolster have the right portfolio going in so that you know that it's the right fit for your risk tolerance, and then bolster yourself with a lot of patience to ride it out because we know downturns happen, upturns follow downturns, and upturns typically last longer. But ultimately, no one can control what happens in a given financial market in a given year. But there is good news that we can control some things. So, one thing our team has found in working with clients for the past 4 decades and navigating dozens of downturns during those 40 years is that at the end of the day, people want to know how will these headlines, how will my changing financial statements affect me? Will they still be able to get that monthly payment that they're used to from their retirement account? Will they be able to afford their kids' college? Can they still retire when they wanted to? And that's what we always return to at the end of the day, so that maybe when markets are moving, we just pull up the financial plan and say, you know what, you're still on track. You're still on track. Your goals are met. Even though the news looks scary, you're still going to be fine. That is kind of the core of how we talk to clients during this time, is just going back to the basics. Are you still on track to meet your goal? So, because each of our clients does have an individualized financial plan, and it's really a living, breathing plan that just doesn't sit in a binder and collect dust. So I guess that's my first question for your clients, Jackie, is do they have a trusted person they can turn to during scary times to help determine what's happening in the world and how it will affect them specifically? So that's number one. Then we can get into more tactical ideas. For example, making sure clients have sufficient cash reserves to help them ride out volatile times. For most of my clients that are in retirement, I try to have at least 1 year of their required minimum distributions or the money they need for living expenses segregated in a safe money market mutual fund. This gives the client a lot of comfort that they have funds stashed aside so that we don't have to sell when stocks are down. So that's number two.
Right.
And
I
thinking
think,
about that, coming out of a divorce, and if you're, again, getting financial assets, do you have safe money aside?
mhm.
Maybe not for retirement, but maybe it's for, what you're going to be living on or supporting your family on in the new world, in this new order of your life. Number three, tax loss harvesting. And again, turning lemons into lemonade. It's a strategy that looks at capturing losses on any securities that might be trading at a loss to lower your tax burden for the year, and ultimately with the goal of boosting after-tax returns. So there's a lot of specifics on this that you have to do to make sure you do it right and you don't run afoul of the IRS rules. It's why it's helpful to have a professional helping you before you try it at home, but it's
Yeah.
something that we are looking at all the time on clients' behalf during that time. And number four, Roth IRA conversions. So this is the practice of converting funds from a traditional IRA into a Roth IRA. And that means paying taxes now at ideally a lower rate in the hopes of saving taxes on the long term. So when stock prices fall, that means you can hopefully convert more shares for the same dollar amount. And then when those securities ideally rebound, you see all that growth shifted to a tax-free account when markets recover, assuming that you follow all the rules of Roth 401, a Roth IRA, some of which are in the disclaimer at the bottom. But Roth conversions can be really powerful during market declines. And then lastly, portfolio rebalancing, which means aligning the portfolio with those long-term targets that we saw in the previous slide, and also potentially enhancing your after-tax investment outcomes over time. And really buying low, selling highs at the core, really the cornerstone of almost everything with this investment strategy. And that's what portfolio rebalancing is about. So in practice, when stocks fall significantly, clients become underweight stocks compared to their asset allocation goal. And in that time, we're adding to stocks in a disciplined and strategic way to help our clients achieve that rate of return necessary to attain those goals that we talked about in their financial plan. So those are 5 things that you can control
Those are all
during this time.
very powerful ideas that I just want to caution anyone watching that you really need a financial professional to help you make sure that you're doing these right, especially the last three. So,
Yes,
you want to make
yes,
sure that you are working with someone like you or someone that is guiding this process, because this can be complicated, but can save so much money.
yeah. Yeah, and what I'm hoping really with this is not to go and do it yourself. Definitely not. That is fraught for doing something wrong, but you don't always know what you don't know.
Mhm.
And so I want you to know that there are things that you can do during times when the markets are down, and call somebody, call an advisor, call a professional, and talk it through.
Absolutely.
So
Okay.
Jackie, I'd love to hear your take. So this is my, this is kind of abbreviated version of what I've been talking to all of my clients about over the last few months during this time of volatility. And you're the expert on the divorce financial implications. So I'd love to hear your take on all of these ideas.
So I'm so glad that you brought up all of the things you did to put that context in, because I think that is so important to look at the bigger picture. And I wanted to make sure that when I give out the next information, that it has that context of where you might be talking about a short time period when you're getting divorced, that maybe you need to deviate from some of those long-term strategies, but you still need to have those long-term strategies in place. So let's dive in and talk about rocky markets and divorce. Lauren, as you have very eloquently described, a long-term strategy of maintaining your game plan, even when markets are experiencing short-term volatility, is certainly best. But that might not always be the case when you're getting divorced. The next few slides are going to help guide our clients, through the financial impact of divorce on investment planning. And I would say that, we need to think about differentiating between short-term and long-term investment goals. So does the divorce change your time horizon for any of your investments? And I'm going to give a couple examples of when it might change your time horizon. So if we were to look back at a couple of your slides that you had previously shown, where you had the different time frames in mind. So over the short term, there's going to be extreme volatility, right? And over the medium term, it kind of will average itself out. And in the long term, you're certainly better off maintaining your long-term plan to get the results that you want out of your portfolio. But in that short-term time frame, and most people that are getting divorced, it takes anywhere between 6 months, let's say, to a year and a half on average. If you have minor children in Michigan, there's a 6-month waiting period that you have to, unless you waive that time period. So that's a short-term time frame. That's, we're not talking about between now and retirement date that's 20 years down the line. So I'm gonna go through that a little bit. What used to be a 10 or 15 year time horizon might suddenly be shortened to 1 or 2 years. If somebody, like you said, is buying a house right now and they need to use their retirement assets for that, which I see in many cases. Anything that you need immediately, any money that you need immediately for a goal, whether it's buying a house after the divorce, paying off your legal bills, having 1 year of cash reserves available to you, those should not be invested in high risk assets, in my opinion. Next, we would want to ask, is there a plan to cash in any brokerage or retirement accounts as a result of the divorce? So that could trigger tax implications, early withdrawal penalties. It may affect long-term financial security if you're giving up too much of your long-term money and moving it away from those long-term goals. So it's a decision that needs to be made with a lot of care and thought and proper advice. So I'm not suggesting that any of my clients who are in the process of divorce immediately run out and liquidate everything to cash. That is not the message that I'm trying to get across. But we need to think about it in a more thoughtful way than I think happens in a lot of divorce cases. And again, it's very understandable. When you're getting divorced, your attorney is advising you about so many different financial issues that are coming your way, about spousal support. Can you afford to keep the house? Can you not afford to keep the house? You're looking at so many big picture items. It's very rare that I hear someone talk to their lawyer or even their financial advisor through the divorce, like me, about what about some of this short-term volatility? Is it really going to impact me? And for a lot of my clients, it is impacting them. So these are conversations that we need to have. Finally, we want to talk about risk tolerance. So during the transition period, whether or not you can afford, again, to hold out to that long-term time frame, and whether or not you might have a different risk tolerance than your spouse. For a lot of my clients, their spouse handled all the money, making all the financial decisions, and maybe they were okay with 60% up and 30% down in a year because they know that's long-term money, but you might not be okay with that. And so again, this is why we want to talk about what kind of risk tolerance are we taking on even in the midst of the divorce process.
Yeah, those are all great points, Jackie. And just even, I would imagine that many clients might have financial account of your clients might have financial accounts, and hey, I have this huge stock position in it, like a big concentration, and
We
they
had
might
one of
not
those.
know. What's that?
You and I think Collaborated on one of
We've
those.
collaborated on a lot of
Uh-huh.
stuff, and we've seen a lot, and so that's the benefit let your wisdom guide your clients from making mistakes that have come before. And because one stock can really move a lot,
It
and if
can.
that's where the bulk of your money is, and you might not know it until you see it.
Right. And that's always my goal with clients is that if they, and I've had clients that they, as long as they understand the risk involved of keeping their stocks invested in very risky investments while the divorce is pending, and they understand the pros and cons of that, I'm okay with that. I just want to make
Mhm.
sure that they understand it. And a lot of my clients, they don't have that financial literacy background that they need to make those kinds of decisions. So I want to encourage anybody listening to this right now, if you have these kinds of questions, ask your financial advisor, ask your lawyer. If you're working with a divorce financial planner, if you're one of my clients, um, ask me, should we talk about this if I don't bring that up? Because this is something that it absolutely needs to be raised. So Lauren, let's take a look at some numbers and try to put the numbers to this more concrete so that people watching can understand. And I want to point out this is not a real case. It's a made up case, hypothetical. These are not real people. And I've really tried to simplify it to there are nuances about how we would treat these assets in a divorce that I'm skimming over the surface of to make it simple to understand. This is a case of Roger and Jill. They've been married for 20 years. Roger wants to keep the house and the equity in the house, which is the fair market value that they've agreed upon minus the current mortgage, is about $300,000. They've got a mortgage of about 350. Now he can't afford to refinance the house. Interest rates are high right now, and he can't afford to refinance to take out additional money to pay Jill her share of that equity. So he has suggested, how about Jill take on all of the retirement assets, net of the taxes, which again, I'm skimming over what that means, but um, that she take equivalent investment assets and he walk away from all of those in order to just keep the home equity. So he's offering her $50,000 in the brokerage account and $250,000 in the retirement account. And I want you to look at the date that I've used here. So in the upper left corner of this slide, you can see that I said these were the values of their assets as of December 15th, 2019, which was their date of divorce. And if anyone's watching this, you can go backwards and take a look at what the market was doing during that time. That was right before COVID hit. So there's going to be some unexpected volatility coming down the pike. Roger was the one that handled all of the investment decisions during the marriage, but he has assured Jill, if you take these assets and I take the house, I can give you a little instruction on how I've managed them, but you can easily take over managing these investments. Um, so let's take a look and see what happened next.
So on paper, it all looked even.
Yeah, it was absolutely equal. It was an equal settlement. And if we fast forward to February 20th, 2020, which is really right before the stock market really dramatically took a dive, um, that due to COVID-19, and I know anybody watching this certainly remembers that time. In this particular case, the settlement was fair. On the date of the division, they both received 50% of the marital estate. Um, on paper it was equal, but here's where things went wrong. Jill didn't fully evaluate her ability to handle short-term market risk after the divorce. Because she needed to access a significant portion of her investments fairly quickly, her financial situation changed. So she didn't have time to leave these investments in and ride them out. She took on all of the short-term risk. And now maybe there would have been some risk associated as well with Rogers share of the assets, right?
Mhm.
So nobody can predict what's going to happen in the stock market in the short term, and no one can predict what's going to happen in the real estate market. Hello, 2007. So, it's not necessarily that there was anything wrong with this agreement. But even though her investment horizon changed and she knew that she was going to need this money, no one could have predicted that the market would have crashed when it did, but there could have been some conversation with Jill about the kind of risk that she was taking on. As Lauren presented, when the market dips, as you were talking about earlier, the best move, if you can afford it, is to wait it out. if you can stomach the rockiness and if you can afford to leave that money there. But if you know you're going to need that money in the next 3 to 5 years, you should not leave that money in the stock market. Unfortunately, Jill didn't do that. Once the settlement is final, you can't go back and change it in Michigan. So unless you have made a mutual mistake or one person was mentally incompetent when they agreed to the settlement, you can't go back and change it. So I mean, she could go back and try to renegotiate a different amount. But again, this is just a good reminder that equal in a marital division of assets doesn't always mean equitable or fair, especially when one party is taking on more risk in that what they walk away with in the divorce. It's also really important to note here that division date matters. So, in terms of what could have been done differently, what could have been done is we could have, and we can take a look at can we flip to that next slide here? So what steps could Jill have taken to prepare for her settlement agreement? Is there anything that she could have done differently if she was working with a financial advisor? So I have many clients that have been in this situation. I have clients right now that are in this situation. So we want to always take a look at the actual account statements to assess the risk level in the portfolio. Jill did not have access to the account statements, only the value. And it's very common in divorce cases in Michigan that even the best attorneys are going off of a number and maybe not necessarily the statement. And even if they have the statement, they're not looking to see how is the money allocated. They're just looking to make sure that all of the money is actually there. There isn't a loan, the money is fully vested. But we really need to consider, what is this money invested in right now? If Roger's portfolio had been invested in cash, I had a case yesterday. The husband was the investment manager. He had already liquidated his retirement account to the money market. So I don't know that I would recommend that for his
Right.
long-term
That's
benefit.
drastic, right?
Drastic, right? But to prepare for this short-term transition of money, we weren't worried about my client who was getting a large portion of that account and she was going to need to cash it in. So we weren't
Yeah.
worried about it being safe. So what Jill could have done if she had taken a look at the statement and probably gotten some help to look at it from a financial advisor, she could have requested that whatever portion she was going to be receiving, for most people, it's 50%. If she has a different risk tolerance and a different time horizon for that money than her spouse did, she can request during the divorce process that her share be liquidated to a money market. Inside of a retirement account, that's not going to trigger any tax consequences. Depending on how the money is invested, there might be some other issues with that, which again, it would be case specific. If it was inside of a brokerage account, however, there could be some tax consequences, and that would need to be evaluated by a financial advisor too before asking that. But the big issue here that Jill and her attorney overlooked was determining were there any barriers to her receiving the cash that they knew she was going to need to buy a new home. One, investment risk. That's related to time horizon and how the money is invested. Two, if Jill is really waiting for that money for a down payment on a house and it's inside of a qualified or employer-sponsored retirement account, there's a separate legal document that needs to be prepared called a quadro. It could take up to 6 months or a year to get that money transferred. So timing wise, that might not be the best strategy. And again, I'm not suggesting that strategy changes, just that you as the client, you educate yourself about some of these barriers. And there may be taxes or other penalties owed on moving your money into something liquid. So all of those pros and cons need to be weighed against the idea of you might be missing out on some incredible market gains too. As Lauren mentioned, you said there were 5 days in the market that were related to the majority of the gain for a year. And we don't
and they
know.
typically follow those down days. So if you're going in
Exactly.
with a strategy like Jackie's saying, a good scenario, maybe for these example clients, once Jill got the money, she might have said, hey, you know what? Let me understand what I'm getting, maybe in January. And also what might I need this year to draw on? And let's put that off to the side. But then the rest she might have decided was okay.
Right, absolutely. And what's important for clients to remember is that once the divorce is done and the assets have not been transferred into their name, either with the quadro or if it's an IRA account with an IRA transfer or a brokerage account that's not in their name, they don't have any control over the investment of that account. So
Mhm.
again, another case that I had, my client called me and he was panicked when the market dropped recently, liquidated everything to cash. It took a few days for that to happen. And then he said, and then he missed out on all the gain that came
Yeah,
in the next day. And again, that's because market timing doesn't work. Nobody
yeah,
knows when the market's going to go back up, how much it's going to go back up, and nobody knows exactly when to get out. That's why a divorce really should trigger a reevaluation of some of those short-term goals and an evaluation of assessing how your money is invested. You can't
yeah,
wait until the divorce is over. In other words, you
yeah,
need to, while the divorce is pending, you need to see how is my money invested.
yeah. Or and you can't wait till the next crisis happens. You want to do it. You want to do it as soon as you can.
Right, exactly. Because like you said, nobody knows when the next crisis, but there's going to be one. There,
Yeah,
if history shows that repeats itself. Um,
yeah,
Another thing to consider is that what Jill could have done is she could have not necessarily in this particular situation because she was getting only the remaining assets that the parties had. But if somebody is more risk averse than the other and they're splitting a retirement account, for example, 50-50 on the date of divorce, they could say, I'm just not comfortable accepting any investment gains and losses. So from the date of divorce until the date I get the money, I would rather just lock in the dollar amount I'm getting on the date of divorce, and if the account goes up, my spouse keeps all of that up. If the account goes down, my spouse takes on all of that decrease. So that is a possible conversation to have with your attorney when you're getting divorced. It's not a conversation that comes up very often because the standard protocol is let's just adjust everything from the date of division to the date of actual distribution to the client by investment earnings and losses. So this again is where it would be really valuable to have a financial advisor that understands how to read a divorce settlement agreement, talk to you, review the language, talk to you about the risks you're taking on, and then you make an educated decision. Um, Not necessarily guaranteed that the other side is going to accept that and say, yeah, I want to take on all of the gains and losses. But again, just having that conversation is so important.
yeah. It feels like with all the Jackie, just like knowledge is power. Just
Exactly.
the more you know going in, the more informed you'll be during the process and then coming out of the process.
Right, exactly. I've got I have another case in here that I wanted to go through. And I think this one brings up a couple different issues. So this situation is Maddie and Scott. Again, I'm using that same date for if you that red box. These are the values of their assets from as of December 15th, 2019. Scott has two retirement accounts in his name. Maddie has one retirement account in her name. So the total assets that Scott has in his name for retirement are worth 350,000 and Maddie has 100,000 in her name. I see this all the time. This is very common. And the settlement agreement says that they're going to equalize these values by Scott is going to give Maddie 125,000 from one of his retirement accounts to equalize their overall positions with the least amount of transfers possible. And that's really common language that we see in a judgment of divorce or a settlement agreement. And there's a good reason for that. Attorneys don't want clients to have to pay for three different transfers. And if these were qualified or employer sponsored accounts, that would require three separate quadros for a drafting fee for each one of those, paying the attorney to review each one and follow up on each one. So it makes sense to try to equalize with the least amount of transfers or quadros necessary. And if so, what would happen typically is the divorce is done, it gets sent to a quadro preparer. Scott and Maddie would both turn over their retirement account statements to the preparer, and the preparer would come up with the actual number to equalize as of the division date, and then would prepare one order to award that amount from Scott to Maddie. So let's see what happened in this situation. Okay, and again, this equalization division date is right before the market took a big tumble. So as of February 20th, 2020, Scott's account went down in value all the way down to 70,000. Retirement account one, retirement account two went down to 175,000. And Maddie's account, which was, if you remember, at 100,000, has only decreased by 5,000. And that is because Maddie was already a really conservative investor
Hmm.
or an uneducated investor, most likely, where she wasn't aware of how, that was going to impact her long-term goals. But she had all of her assets in a money market. And so they didn't take any dip, whereas Scott had his investments invested in a very aggressive portfolio, and they actually each one reduced by 30% during that really short time period. So again, this is why time horizon for your goals matters so much when you're getting divorced. If you were planning for retirement and this is the case, you know what your financial advisor, like Lauren, what you would probably recommend is, okay, if you don't need the money now, let's talk about some of the other things we can control. Should we convert to a Roth IRA? Should we try to do some tax loss harvesting? Those kinds of strategies. But in this situation where, Maddie needed that additional money now, this is a problem. So if the equalization calculation happened on February 20th, Scott would only owe Maddie $75,000 as opposed to the 125 that she was counting on. And let me tell you, I have seen this happen, Lauren, in a lot of situations over the years. I've been doing this for 3 decades, before and after a lot of market downturns and a
Yeah.
lot of market upturns. And this is not a fun situation for Maddie to be in. And
Yeah.
the reason for that is that it's not usually explained to the person receiving the money that, hey, there's a potential risk here to you. So there are some things that Maddie, it obviously Maddie is not a real person, but there are some things that she could have done to, again, try to protect herself, or mitigate some of the risk that she ended up taking on. And that could be simply, we're going to divide all three of these accounts with three separate orders, even though the cost is going to be more to divide them, but at least they would be equally sharing the risk for all of the accounts. One, she could have said, the whatever I'm going to be getting from Scott's account, I'd like that liquidated to a money market right now. And then I'm not going to receive investment gains and losses on my share. I'm just going to get that flat dollar amount. It's when those kinds of conversations don't happen that, in my experience, that clients feel really upset because they didn't know they were taking on any additional risk that this could happen. And, again, there are ways that it can be prevented with conversations with a lawyer. And I'm not blaming lawyers. Lawyers, family law attorneys are in such a complicated area of the law. They know so much about so many different aspects, things that are always changing. Spousal support, property division, child parenting, custody, child support. It wouldn't be fair to expect them to also know how to evaluate the risk in an investment
Mhm.
portfolio. So again,
Right.
that's why it's so important to have a financial advisor during the divorce that can help you with that and bring that education to the table.
Yeah. And especially if she was conservative or just really didn't know enough about her own investments, I imagine it'd be very scary to have your amount you were expecting go down from, in this fictional scenario, 125 to 75 in a very short amount of time.
Oh yeah, very scary, especially she's not going to know it until she actually gets the distribution from the Quadro. So that's, maybe the money would bounce back up somewhat,
Yeah.
due to that, short-term increase, but maybe not. And it's, by that time it's kind of too late. You can't put the toothpaste back in the tube.
Yeah. Wow. Well, I think that was a great review of, how we think about scary times overall for really anyone. And then zooming into specifically what are the things to think about for clients going through divorce, which is great context to have to see how, the typical advice that I'm giving many of my clients that are nervous, there's also additional things to consider for those right in the middle or emerging from a divorce. So I think we were a good team on handling that, Jackie. But I do want to, because our viewers are seeing this during a scary time, and I want to leave your clients with a measure of hope. They, to our viewers, you too can build a diversified portfolio that will meet your financial goals, that it can smooth the ride for you and take advantage of financial planning strategies like we talked about that will improve your financial picture during all kinds of market conditions. So I want to cap off my conversation with you, Jackie, with this chart, which is one of my favorites. This is again that same S&P 500 index plotted against major and majorly scary world events over the last 30 years. So you can see a lot of the things that have happened just in the last 30 years, but you can see over time the US market has been very resilient. So this is my message of hope. Yes, there will be headlines, and we do expect increased volatility and maybe even more pullbacks to come. But we have been through times like this before. And the uneasy feeling that we get during these times is the cost of those strong market returns over the long run. This precipitating events that start that volatility, as you can see here, they're always new. Those always feel new. But we've been through them before and they will come again. The important thing is to have a plan, to stick to that plan, and surround yourself with people you can trust. And Jackie, you're at the top of the list for that. That's for sure. So
As are
thank
you,
you for having
Laura.
me. Thank you for having me. And I think, maybe if there's, again, here's my message of hope over the long run for patients to know what you're getting into, maybe make adjustments for your individual situation. And then also to reiterate, there are things that you can control.
Right. I love that chart. I think that the overall message of that chart for people that aren't used to looking at stock market charts too is how that green line is just consistently up despite all of that volatility in the interim. I love that. And I love how it makes me feel old, Lauren, because some of those things seem like they just happened recently and they were 30 years ago.
Yeah,
So
you probably remember, I think, 9/11 was on the
I
chart.
do.
You
Yeah.
remember what it was. We mentioned a lot of them, COVID, 2007, we've mentioned a lot of them just naturally because they're part of our history.
Right. I remember Enron. So that was on your chart.
Yeah. And because of that, you know, psychological, you know, impact that we have during those scary times, we remember them. It's like we have that visceral physical reaction to these events. And that's what we have to fight against during times like this because we're programmed to react that way.
Right. It's very hard. I think so. I want to circle back around again to this powerful idea of what you can control. And if I were to, certainly you need to have a trusted advisor and is your financial plan on track? So that to me is a long-term question. That is, do you have a long-term financial advisor when the divorce is done that you can use as a thinking partner for yourself that can help make sure that you've got your goals, investment, time horizon, your personal risk tolerance level taken into consideration for your portfolio, which you're going to be in charge of when the divorce is final. Doesn't mean you have to be in charge of it by yourself. No one is expecting anyone to go out and become a financial whiz. And to be quite honest, a lot of the people that I run across who've been managing their assets on their own, after the divorce, they also turn to getting a financial advisor because they might realize that they weren't looking at the whole picture. They weren't looking at tax strategies. They weren't looking at long-term how their money is invested. When everything's going up, it's really easy to be your own investment advisor. So that is really important. What also I think you and I both underlined in the background of all of the things we've discussed is investment literacy. And to be able to advocate for yourself during the divorce, don't expect yourself to know everything, but ask every question that you don't know the answer to. And if you're not sure what the questions are that you should be asking, it probably is time to bring in a financial advisor in the divorce process to help you with that. Only you should be making the decisions, but if you don't have the background and the education to be able to make the decisions, you're putting yourself at a real disadvantage. And always consider all the pros and cons before agreeing to any settlement and make sure that you understand all the words in your language of the settlement agreement or your judgment of divorce before you sign. A lot of it looks like boilerplate and oh, that's just like legal mumbo jumbo, but a lot of it is not. And there are some, the change in one word in the agreement regarding division of retirement accounts or brokerage accounts can make a tremendous difference, whether it's the date of division being different, investment gains and losses not being included. Those are just a few examples of why you really need to have some knowledge and understanding of all of the words in your settlement agreement that relate to the financial pieces.
Mhm. Yeah. So those are great real steps that people can take to take control during a otherwise scary time. So I wanted to leave Jacki, your viewers, with my contact information. You know, we mentioned this idea of financial advisor a lot. If clients don't have one, or if they have one and your advisor's not talking to you about this stuff, and you need a second opinion, for your viewers, I'm willing to give a fee waived initial meeting where just to get to know each other and hopefully leave anyone that comes in the door with a little bit more knowledge than they started with. So here's my phone number, my email. And then speaking of financial literacy, Jacki, if anybody doesn't listen to Jacki's Divorce Rich podcast, you have got to subscribe. I listen to it. There is so much practical knowledge about quadros, about pension separation, about all these things that you don't know if you don't know. So I'm giving you an endorsement
Thank
here.
you.
Yes, it is amazing. Jacki is one of the experts in this field, and that's an understatement. So
Thank you very much. I'm again so grateful to have you do this presentation with me today, Lauren. This is going to be so helpful for so many people, and I plan to use this for years to come. So if you're watching this and it's several years past this tariff issue, these concepts still apply. And I'm sure that Lauren will still be available at the center if you are looking for a post-divorce financial advisor, which I highly recommend to everyone that they sit down with someone like Lauren. I really appreciate that you're giving any of the listeners to this video a free consultation, and I would highly encourage anyone to take advantage of that.
well, thank you for having me, Jacki. And your clients are so lucky to have you. And it's really just been an honor to be able to talk to them with you.
Thanks, Lauren.